Okay, so we're going to start that over as I was muted and they were letting more individuals in the room. And so here we go. All right, so welcome to those of you joining us via Zoom, via Facebook, and via YouTube. We are honored today to have with us Mr. Bruce Norris. And why is Bruce coming to us via Zoom today? Well, 3 weeks ago, we hosted one of our annual educational luncheons. This is an educational event that we host for landlords twice a year, once in the spring, once in the fall. And unfortunately, at the same time as our last event, Florida was going through its recent hurricane. Bruce resides in Florida. And so we're grateful that Bruce, his family, and his investments are all intact. And so Bruce was kind enough with his time to agree to share with us today what he intended to share at our event. How do you get invited to our educational luncheon? Number one, you have to be an owner of multifamily properties. Number two, you have to own within the geographical area that my team and I service. And at this event, we bring together specialists from the areas of real estate law, taxation, lending, and so forth. And we go through all the key metrics of owning multifamily real estate. We go through all the updates with respect to the legalities of owning multifamily real estate. And of course, we touch on market dynamics and we touch on market forecasting. And that's why Mr. Bruce Norris is with us here today. So again, Chris German from the Apartment Dealer, welcome to all of you that are still joining. I see that people are coming in. So very good. Welcome to you. Now, Mr. Norris, for the last 3 decades, has been an investor, hard money lender, developer, and educator. And I affectionately refer to Bruce as the Sultan of SoCal real estate because he had his hands in so many different pots when he was here locally. And then here a couple of years ago, Bruce transplanted to Florida. I'm sure he'll share with us some of the reason behind that. And transplanted nearly 100% of his real estate investments to Florida as well, given the direction in which California real estate was headed and all the rest. And Bruce will walk us through that today. So Mr. Norris, welcome to the Apartment Dealer Show. Sir, it is a pleasure to have you once again.
Chris, thank you for having me. All right. We'll probably talk a little bit about why I end up in Florida. I think after this has to do with looking at charts. The reason I got interested in this, I had an experience in 1980 after I got into the business in 1980, and I did well until about the end of 1989. As a matter of fact, in 1989, I had my first $1 million profit on a project. And I was just so happy, and I felt like I really knew what I was doing. And then I built 7 custom homes in 1989, got done with them June of 1990, happened to be in Palm Springs, a second home area, and the world changed, and I didn't know it was coming. So I had 7 custom homes with $3,000 a month payments. I survived that by making all those payments and trading them for whatever I could get my hands on, including 2 of those houses for a very cool 60-foot yacht that I never started, but I wanted out of those houses that bad. 5 years later, my son Aaron graduates from high school. I buy him a Honda Civic for $15,700, and 2 days later, I buy a 3-bedroom house in Riverside for $13,300. And that event really just shook me because I thought, okay, I used to think real estate never went down, and now I'm buying 3-bedroom houses cheaper than I am a Honda Civic. So I figured somebody had figured all that out, and I went to the library and looked up in microfilm every real estate article for 25 years, from 1970 to 95, that had to do with discussing prices and the future prediction of prices. And no one had ever said in advance, this is what's coming, and then they were correct. So I didn't know if it was possible, but I thought I would try to figure that out. And so we wrote our first report in 97, predicting prices would double. We wrote a report in 2006 talking about California prices crashing. So those 2 documents pointed in different directions that turned out to be true. And so we created some formulas that seemed to work. And that's why Chris has me around. even though I'm not in the apartment world, the housing world does, it definitely has impacts on what happens to single family homes and apartments.
So as Bruce notated that he created these various reports over time, he just recently released what he calls his last report, Uncharted Territory. I purchased a seat to be in that class, an all-day event, and it was quite telling. And so what Bruce shared over the course of that entire day, he's going to give us a sky level view of those analytics over the next 20 minutes or so, and then we're going to be taking questions from you.
So this is the journey of California median price. I got involved in 1974. And an interesting thing happened from 74 to 1981. Real estate interest rates doubled from 7.5 to 15. I became a real estate investor in 1981 at probably the worst time you could have. So that I had to refinance my residence that was pretty much free and clear at 17.5. The reason I'm telling you that is between 74 and 81, real estate prices went up 300% as interest rates doubled. So I'm always amused when somebody tells me when interest rates go up, of course, real estate prices go down, except for that big stretch, right? They never mention that. So what I want you to do is be cautious about thinking automatically that when interest rates go up, it's damaging to real estate prices. And also take a look at what happened in 2007 to 2012. Interest rates were far less than half of what they were in the 80s. And you had a price crash of 50%. So there's a lot more to what makes prices move than interest rates. And we'll talk about some of that. Next slide. In the study that I did originally in 1996, I was trying to find what I thought was a domino chart. Is there a chart that kicks over other charts? And this was the chart that I found. When you're looking at a peak market, this tells you you're there. And once you hit a peak market, there's a series of other charts that typically follow. Affordability, when it hits 17%, and it's done it a few times, 1980, 89, 05, and in 2022, there's always a series of charts that are negative after that. Now, what happened in 2005 is we didn't stop at 17% because we had a lending world that really didn't care if anybody told the truth. And so it went down, and we'll talk about the ramifications of that. But in each of these instances, we had different reactions in the market. In 1980, we had 17%, and we had no price damage for the years after that, despite there was 25 months of inventory for sale and interest rates were in the teens, no price damage. 1990 to 97, interest rates were half of that. We had about a 10% damage. And then interest rates that were very cheap after 2007, when we had affordability finally go back up, prices crashed. So affordability getting low has a domino effect, and we're there. And what happens is affordability gets too low and people stop qualifying. Inventory usually grows. And then also people that are late in the game, sometimes they lose their home. If they lose enough homes, and that's what we figured out, that trumps interest rates. It trumps everything. When you have a glut of foreclosures dominating the marketplace, like we did in 2009 through 2012, you're going to have a price crash. So that's what's interesting about when we take a look at this scenario. We're going to take a look at the math, but also take a look at the other factors that might mitigate what should occur price-wise. Next chart. Go ahead.
Real quick, Bruce. Somebody asked a question while we're on the topic. Affordability, how's that determined? Maybe if you could just give us a quick bird's eye when we're saying affordability, how that's calculated.
It's unique. It's unique to California. So there's not a national equivalent. So what California does is say, how many people, how many households qualify for the existing payment with a 20% down? And so they literally come up with an earnings amount, and then they look at the tax returns, and the affordability is the percentage of tax returns that were filed that technically could get a yes answer at that payment.
And so you said that in this year we hit 17 once again.
Well, unfortunately, you never had a chance to get to 17. You went from 24 to 16 in one move, in one quarter, which has never happened. Which actually has a lot of positive effects, not negative, and we'll cover that.
Okay.
Okay. So, history of interest rates. I mean, ever since I've been a participant, from 74 to 81, obviously that was really a volatile time. But ever since then, and for a long time, almost 40 years, they've been coming down. One of the things when you write reports and you have titles and you have people that follow what you say, you're stuck with the title forever. So when I call California crash in 2006, if that did not happen, I would have heard about it for the rest of my life and somebody would have shown me that cover. Now, years later, we had a report, and I forget the exact year that we wrote it, but 2% mortgage rates and 40 trillion in debt. And that was a kind of a longer prognosis of what was going to occur. And fortunately, we did get into the twos in interest rates, and now we're on the opposite end. So we've gone from about 3.1 to 7 in record time. If you look at 7, that doesn't seem like a big deal, except for we waited so long that it'll have a definite impact on what the people next can pay. Next chart. So this is a quick look at the inflation of the 70s. So it was an 8-year journey. If you look at all those years, all that was really high inflation for quite some time. So go to the next chart, Joey, and we'll take a look at, we've been suffering it for about 1.5 years or so, and that's it. So our length of time dealing with inflation has been so short compared to the 70s. And it'll be interesting to see how long this takes to resolve. Next chart. We created a mathematical formula for figuring out where we were in the cycle, and it's called a modometer. I'm really big on the mood of the participant because I've watched it trump what you think would occur. So on the right-hand side, that's the percentage of the median income it takes to buy the median price house with 20% down. So it's kind of like the affordability index, but the percentage on the right is telling. So what happens when you get to, say, over 55%, you're in euphoric territory, and you can get higher, but you're going to probably give it back. And by the way, when it's most expensive, so think about 2021, if you had stuff for sale the last half of 2021, all you had was multiple offers upon multiple offers. And the person that needed financing actually made the cash buyers pay more than they ever would have. So we had one particular property that was on the market for 4 hours. We had 11 cash offers and we had one financed offer, a VA buyer. The VA buyer kept going up in price. We settled. This was a house when we started building, we thought it was going to go for 4.25. We opened the price at 5.25. Within 4 hours, it went to 577. And 3 other buyers that were cash buyers lost to the VA buyer and transferred to each of those bought another house that was under construction for the price that was set by the one person that had to get financing. So I'm telling you partly because that's what got crazy in the last half of 2021. Should we have gotten to those prices? No. And so when we start talking about, well, prices have declined by 10% since then, you're not giving back something you should have ever had. So that's my take on that. There's a lot of that price that would never have occurred because you had 3 days of inventory and everybody that wanted a house had to struggle to get, I mean, they probably had to bid on 20 houses to get one. And they were used to getting overbid. That was the marketplace, okay? So anyway, this modometer also tells you that there's a downside. So look at where, we're talking about being in the 60s, but there's also times where you're in 35. And there's even a time when you're below 30. Now, for just an investor, this is the greatest cheat sheet you've ever seen. So if you have a market that you're under 30, it means everybody's terrified of the product and no one's buying it, and it's on sale. And it's on sale to such an extent that it's probably the buy of a lifetime. So take a look at 2011, 2012, 27%. By the way, when we were in that cycle, say after 2009, when things really got bad at 28%, you'd think, oh, well, everybody can afford it. They want it. Oh, no, they didn't want it. Volume shrunk, and we had to bribe people with an $8,000 check to buy a house that was on sale. So that's what the moodometer does, is chart the mood of the participant. But you can also see, and this is what we're about to talk about, it's not normal to be over 50%. It's much more normal to be less than that. So now when we have this interest rate hike, it also dampens the mood of the participant. So let's go to the next chart. So if it's just a math equation that we're talking about, if we're thinking, okay, is California real estate going to take a price hit? If it's just a math equation, the answer is definitely yes, absolutely. So this is a moodometer at 45%. And that gives you a payment. See what I can't see at the very end. The moodometer, oh, it's because it's going to say 45. So to get to a 45% moodometer reading, which is average, maybe even more than better than average, your median price would go from 8s to 5.25. If it went to 40% moodometer reading, your price would go to 465. So that's
what you're saying, Bruce. So let's soak that in for a second. So median price, again, 800, based upon the math, and affordability drops to 465 with a median income 40%.
That's right. Which is not a distressed market. A distressed market is 20s and 30s. So 45 or 40 is a very normal market. So again, if it's just a math equation, yeah, we're in for a big hit. So let's see if there's any mitigating factors. So what could prevent it? Next. So historically, and I've studied this really carefully because I looked at like 80 and 81, you have 25 months of inventory and interest rates are crazy and you don't have a price hit. Okay, how could that happen? Well, one of the things that wasn't present was a dominant REO presence. REOs were 1 in 4. They didn't dominate the market. Go to 2009, 10, and 11, it was 70% of the market. It was the market. It dictated every comp. I don't see that happening this time. I don't see lenders willing to foreclose on a ton of people. And I don't see a bunch of people that are going to be missing their payment. Keep in mind, rents, for instance, where in Florida have gone up probably 50% in 2 years. Well, oddly enough, that's a really good thing, because if you think I'm going to walk away from my 3% fixed mortgage and I'm going to go rent a house for $500 more, you probably aren't going to do that. Even if you're upside down, you're not going to do that. And by the way, what if you had to leave? Let's say you lost your job and you're moving to another state and you're upside down on your house, but it has a cash flow. Are you going to lose it or are you going to rent it? So this is why that chart, uncharted territory, is actually a statement of saying we have never in our lifetime had what we have right now. So the outcome is yet to be determined. It depends on the participants. It really does. Okay, next. One thing that happened this time is the new home builders didn't participate. So we had this explosion of price, and that usually takes us on a journey where the new home construction at the very bottom is like a 60,000 year, because of the REOs are cheaper and no one wants a new house. And it builds momentum the whole cycle until it's 150. That didn't happen. The whole time we got stuck at 60,000 or less. That was it. Well, what happens when you get stuck, and this is what usually happens, builders are also momentum players. So imagine in 2006, you're building homes every house that you're building has a line in waiting, waiting to buy it. How could you shut down your operation and say, you know what, I think in 2 years, this is all going to be in trouble. So what happens is they still build at 150,000 pace. They get stuck with a bunch of houses. Those things get auctioned off, wipe out the person with 20% down, and creates its own nightmare of foreclosures. There's no way that's going to happen this time. There hasn't been enough construction for that to occur. Next chart or next page. So you also have many years over 100,000, up to 150. We didn't have any of that. So we actually have a housing shortage in California. So that hasn't occurred either. In every other cycle from at the end of 1980, 89, 2005, those numbers about 150,000 each time. This time 60,000, and not a lot of houses in between. So you actually have a housing shortage. It's very interesting. Once again, unprecedented. Next. So this is, I wanted to point out this. So in 2005, we got to 17 and we went flying past it, got down to about 13, got down to 12 or 11 in 2006. What we basically did in the highest volume sales that we'll ever see, we buried 1.5 million people upside down in ownership, because we camped out at a number that we normally leave very quickly. So take a look at the other times where it's 17% affordability. So 1980, 81, 2 years we're up to 30. In 89, 2 years we're up to 25. So we leave that 17 because it's just an unbearable number and people just stop buying. Okay. Well, they didn't have a chance to stop buying because we didn't care if they got into it or not. And so you stuck 1.5 million people at that point. Okay, next page. So remember, we had all kinds of adjustable loans. This time, everybody that got stuck, let's say in the first quarter, when affordability went from 24 to 16, they got a fixed rate loan. Go to the next one. Okay, again, we were there for a long time. This time, we were there when affordability went from 24 to 16. We were there for 3 months. Go to the next slide. I already covered this. So this is the chart that's interesting. So where are you going to have a pack of motivated sellers? Go to the next slide. It would almost have to come from the unemployed, the future unemployed. So where's the inventory going to come from that has a motivated seller? Maybe it's the unemployed, but here's the job openings. And the job openings are enormous, and the people that are looking for those jobs outnumber the job openings. So it's an interesting time that you have pretty much record low unemployment and you have more jobs chasing people. Maybe that'll change, but right now it's still true. Next chart. So what typically happens when you hit affordability 17 is your volume of sales go down. That's accompanied with a rise in actual trustee sales, but the ratios also change because you're selling half as many homes. So what's very likely to happen in California next, go to the next chart, Joey. So a normal sales year is 400,000. That's not a big year. We probably had that most of the time over the last decade. When you have a typical great year like 2005, it's over 500,000. But let's say 400,000 sales is where we would be at, and about 30% of those are cash transactions. I expect sales will go into the 200s in number. So I think you'll probably have between a 40 and 50% hit on volume of sales. But that'll be represented by an enormous amount of percentage of cash buyers who will not be affected by the interest rate change at all. So what'll start happening is you'll have a very honest market of seller. Now, what happens is, what if, okay, forget that you're not going to have a bunch of REOs. That's not going to be a participant. How many people are going to walk away from a 2 or 3% mortgage to sign up for a 7? See, this is what we haven't had before. Uncharted territory is, okay, so you want to change your current mortgage rate that's 2 or 3 and go to a 7? What's going to prompt you to do that? My bet is they just stay there, heck with it. The more people that stay there, and by the way, used inventory, existing inventory is 85% plus of the California market. If a lot of that never shows up and you have a small amount of buyers that match a small amount of inventory for sale, you could have a lot more stable market than you mathematically you should. Now, the one thing the people in charge could do, and it would be really smart, is to let the financing that exists move forward. Let somebody buy a house and take it over. We actually were invited to Washington, D.C. last summer. It was a one-on-one meeting with the CEO of Fannie Mae, and that was the discussion. When interest rates rise, that's the biggest favor you could do to the real estate industry, is to have that mortgage rate that's a 2 or 3 or 4 be allowed to be taken over by somebody and stay on the house. So they haven't pulled that one off yet. A lot of times things that are common sense don't happen, but that was the suggestion. So right now you really have kind of an interesting market. You have interest rates going up, you have volume of sales really declining, but you don't have a gigantic price hit yet because you don't have 20 months of inventory. Look at the inventory in the 80s and you have no price damage and you have an interest rate that's like 14%. That's astonishing, but that's what happened.
So go ahead, Bruce. I'm sorry.
No, go ahead.
I was going to say, so if I gather what you're saying here is that overall sales will go down, but values will stay roughly about the same. And so I have a lot of things bouncing around in my head because obviously, yeah, for someone who just refinanced at like myself, I refinanced my house just because of the lower rate. I didn't take any cash out. I think I'm at 2.5% or something. Why would I go buy another house at 7 unless I have a change in lifestyle? So I guess the people that will have a need, right? Death, divorce, family size, relocation of job, they're going to be stepping into a market now where their dollar goes further. So that's one thought I'm having. The second thought I'm having is
let's back up for just a second.
Okay.
You say their dollar goes further. Well, there's not a discount.
I'm sorry, not as far. I'm sorry.
Okay. Now, where it does go further is when you sell in New York. Let's say you owe 50% on your New York house at 2-3%. Why would you do that? Because you can own the same house or better in Florida free and clear. So the markets that are much lower in median price are going to attract people that had mortgages from other areas.
And that's where I was going, is the relocation factor, because
absolutely.
And because you have, for example, today, national poll was just released. I don't know if you heard this one. 50% of the respondents said they have either looked or they're going to look for a second job out of need because of inflation. Of the 50%, 34% said they're already looking. The other 16% said they plan to look. So you have this piece of the economy. And I know it's an election year. A lot of these numbers are getting baked. But you have companies that are announcing major layoffs. And so it's interesting that the numbers show that there's all these open jobs. And at the same time, you have companies that are laying off because of everything that's going on in the economy. The consumers being squeezed. And so I don't think, a combination of these things void well, for at least here in California, void well for the housing market.
No, again, if it's a math function, you got a 40% price coming your way. But okay, but that's so far being mitigated by people not having a bunch of homes up for sale. They're staying. And so your cash buyer becomes a bigger, the less number of sales, the higher percentage of your cash buyers. And you'll just have an adjustable loan start emerging that'll take a 7 to a 5 for 5 years. And I think the mentality there is probably, okay, well, we're so familiar with low interest rates that people will think, okay, well, within 5 years, that'll be back down. So that might be in their head.
Yeah. Well, so far the Fed raising rates hot and heavy, that hasn't really pushed the needle on inflation. And many believe they're going to raise it another 3/4 of a point in November. They'll have to increase it at least another 0.5 point there, because inflation is still a big problem.
Yeah. No, it is. I mean, so if you're starting now, I mean, what they've created is two worlds. You've got the world of people that are already in and the people that are trying to get in. And the ratio that's going to take of what you earn is going to be enormously different than the 2.5% loan that you got. So you'll either be buying an 800 square foot home, or you'll pass and you'll move out of the state, or you'll rent. But rent is no bargain either, right? I mean, that's taking a lot of percentage of people's money.
Oh, sure. Sure. And yeah, I'm gonna go there here in a second, but I stopped you mid swing here. Did you have additional slides?
Joey, let's see what we got. Okay, we already talked about that. Yeah, I think that's pretty much it. I think, that's what's one of the things about this report. It just gave scenarios of possibility. It didn't really land on a square and say, this is definitely going to happen. Because, all right, I think that it will be far less damaging in price than it should be by the math formula, which is good.
Yeah, I mean, it just takes, at least in my world, multifamily, same can be said. Well, most landlords have a very low interest rate, even though with the eviction moratoriums and rent control and the rest, most are faring well. Why would you see a decline in values? Well, we are combating interest rates as well. And at our most recent educational event, I walked the attendees through, well, what does a 1% increase mean? Because we don't need to go from the 4.25% that we were at the beginning of the year to 10. You don't need to see that. God forbid we see something like that, because for every 1% that interest rates go up, net income goes down by 15% on a multifamily property that's leveraged. It's that ratio. So we've gone from 4.25 to about 5.5, 5.6. And what you're starting to see is buildings beginning to take price reductions, buildings staying on the market longer, while at the same time, individual cities are now advancing their own RSOs, rent stabilization ordinances. And so this is, what you see in our world. And so one might ask, well, this housing issue, it's a good thing, because if values stay propped up, then tenants, push come to shove, will remain tenants. But I'm asking myself, well, if 50% of people, not of people, but of this recent, a good amount of people are looking for a second job because they're being squeezed. Many, I assume, those being homeowners. Those that have, again, a lifestyle change, divorce, death, you inherit a property, the kids just want to sell. Hey, the price you need to move it. Well, you're selling to that second world you mentioned, the people that are trying to get in. Well, these people that are trying to get in, they've lost a lot of buying power with the rates having gone from 3 to 7.
Absolutely.
But if they really want to sell the house, then you got to move it. I don't know, how many comps does it take in a given neighborhood where now that becomes the new price? And so, with single family housing, that's funny.
Not many. Not many. Well, the modometer does that has an equivalent world to me, and it's a cap rate in your world.
Mm-hmm.
So what's the history of cap rates? Are we at a number we've never been before?
Well, cap rates are rising, and attendees watching this might say, well, really? They are. You have to see new buildings coming on the market. They are rising because if you're buying a building at a 4% cap rate and the interest rate currently is 5.5%, you're losing 1.5% on the money borrowed. And so the question becomes, well, what is investors' tolerance? What is buyers' intolerance? I'm in the middle of a very large multifamily sale here in the city of Claremont. We have those two competing things. Claremont just announced they're thinking about their own rent stabilization ordinance. At the same time, buyers saying, hey, rates are crazy. And it's they're only 5.5, but they're saying they're crazy because they're not 3.5.
Right.
They didn't push. The buyer did not push to a price that I know they would have 3 months ago. And they said that themselves. Chris, 3 months ago, we would have paid more for this building because the borrowed money, the leverage has an impact on the rate of return. Hence, they want a higher cap rate in order to do the deal. And this is in a fairly good neighborhood, nice property. But at the end of the day, we own property for cash flow, appreciation, and tax savings. You don't just own it so you can say, hey, I own this specific address. And the cash flow is taking a hit right now with the higher interest rates.
How often have we been at this cap rate over the last 30 years, or 40 years? Just curious.
Yeah, so we went through 2 decades of data at our recent event. And what you see that is that you don't see cap rates and interest rates inverse of each other quite often or for that long. So it has happened where the cap rates are lower than the interest rates, but we don't stay there very long. And you already see we have not been at a 5.5% interest rate for very long. And there's already pushback from the market that, hey, 4% cap rates don't make sense. 4.25% don't make sense. And of course, there are some of those neighborhoods that, higher end neighborhoods that still may be on the lower spectrum of the cap rates. But again, buyers are saying they believe there's going to be a change in the market. And so that's what I was going to ask you next, Bruce, is that in 2019, you were at our event, October of 2019. At that event, you said, wouldn't it be interesting if we had a, what'd you call, not a black swan event, but a, something that would come from out of nowhere. I forget the term that you use now, but you somehow you prophesied.
I had I had a whole chapter on it, and I'm trying to think of the word too, because it can come from multiple angles.
Well, in 2020, what did we have? We had a COVID. And so what's interesting about 2019 is you're on stage telling the attendees, hey, look, affordability's never been better, unemployment's never been lower, but yet the housing market is not moving. That's kind of where we were in 2019, single family houses. If we go to multifamily, and I showed the video from 2019, I'm on stage saying, look, there's already a change in the direction of values. 17 and 18, we've been kind of bumping along sideways. Now we're beginning to see values take a hit. But here comes COVID. And interestingly enough, COVID comes, everybody said, you know what? We can't go outside without a bodysuit and a mask and gloves, but what we can do is go buy a house of the strangest things. And so I've heard many pundits say, well, it's because this and that. To me, I look at human nature. I think people were stuck at home, looking around saying, you know what, maybe this isn't the best neighborhood. Maybe we don't have as much space as we really want. And on and on. And the law of familiarity kicked in. We're like, you know what, let's do something new. We need variety. We feel bad about COVID and not being able to visit family and travel. Let's get into a new house that gives us this sense of variety. Now, again, I'm really leaning on just how people behave. But how else can you explain that people risked life and health to go stand in a line sometimes for half an hour at some of these open houses to buy these homes and pay the prices that they were, and to overbid and the rest during lockdowns and everything else? Well, how do you explain that? Well,
did you know they did that to every other asset? Okay, so I think it wasn't just the housing, it was the boat world. It's the piano world. I think people went, okay, life is short. I've wanted one of these for a long time, or I've wanted that office in my house for a long time, or I've wanted a better location for a long time. And yeah, that pandemic pushed the button. And did I say a systemic event? Was that the
systemic
word?
There you go.
Yeah. So that can come in a lot of forms, and that's one of them. And Chris, what what was interesting about that, there's a report that I buy all the time, and they appraise the same properties, maybe 2,000 of them every 6 months, and they have for 30 years. And in that year, the end of 2019, about 20 some percent of those had already gone negative 6 months over 6 months. And that was, wow, even with all these charts in such perfect order, that's crazy. But that was what was going on. And we had just seen interest rates. Remember, they were starting to play with interest rates some. Not that they had gotten out of hand, but they had gone in the other direction. So yeah, that's well, I guess what's interesting is that mood shift lasted 2 years plus, and took the median price from California almost up 50%. It was like a little around 600 and almost got to 900. So it's a really good question. Is that whole gain nonsense? Emotional? But what got combined with that was an interest rate that made that okay. That's the craziest thing. But if you're borrowing at 2.5, you can pay 900 for something.
Well, and so you have a glutton of cash that's put into the economy, pushes an economy that was already on tilt, gives us another one last breath, right? And rental rates went up historically the last 2 years. And it was interesting at our event. I asked the crowd, how many of you believe, after I had just went through all the data saying 2 years back to back historic gains on rental rates, how many of you believe rental rates are going to go up at this same click next year? Many raised their hands until I showed them a couple articles where actually rents just pulled back for the first time in August. Not a huge percentage, but for the first time, we see some resistance on rental rates, whereas probably since June of 2020, they had taken off like a rocket because they were pushed out of the housing market.
Well, what's also interesting is that there's a chart of expectation of a rent increase by the renter. Have you ever seen that chart?
No.
That's an interesting chart because they expect a 10% rate increase. Wow. The last chart I saw, they're mentally ready to, I've got to pay 10% more next year.
And so my words are here that going back to 2019, that things were already shifting. We have this systemic event. People start doing irrational things. And as you said, in different markets, housing, the stock market, cryptocurrency, people start overpaying for vehicles, $20,000, $30,000, $40,000, overpaying on a vehicle they know is going to lose value the minute they dry it off the lot. Apparently they needed a new vehicle that bad. I'm telling you, it's human nature. They wanted variety. They wanted something new because life had changed. But now here we are. Now we have the ramifications of COVID. And I think that's what we're dealing with now is the leftovers of COVID.
Yeah.
What would have occurred more naturally had we went through a normal market cycle after 2019, we have only exacerbated the problem by pumping in all this money. Apparently they want to put in more money in the economy, if you can believe that or not. And I just don't know what the argument is that, oh yeah, we see home prices going up from here. Oh yeah, people are looking for second jobs. We see rental rates pulling back, but yet we think, we're still going to uptick from there. I just don't see the argument from the other side.
No, I think this cycle, it should be downright ugly, but mitigated by all these things that are in place for the first time. So it's hard to have a price crash if you only have enough homes that are available to meet the people that have to buy. If that's multiple like 24 months supply of inventory and you've got 3 months of buyers, well, that's a whole different scenario. Prices will drop like a rock. If that's lender-owned property, it'll drop like a rock. But if it's just buyer and seller and you've got a 3-month supply of houses for sale and you got a bunch of buyers, half of which are cash, it's really interesting. It just may not be the math may not work out, to be as bad as it could be.
Now, when you said with the math, you gave the example of maybe someone sells in New York, they go to another state where it's more affordable. So, going back 10 years ago, I would have multifamily investors ask me, hey, Chris, well, what do you think about buying sell what I have here in California, go buy a building in Arizona, New Mexico, Texas, basically the Sun Belt. But they were never going to do it. They were just toying with the idea. But now you see people actually selling and purchasing investments out of state. Of course, you put your money on the line and essentially exchanged most of what you had, if not all of it, correct me if I'm wrong, but into Florida.
Yeah.
What led to that decision ultimately? And how does one who used to own and manage here locally literally say, I'm going to go to the opposite end of the nation? How does that all happen? How do you do it successfully?
Well, first of all, I had been in Florida since 1992 in Hurricane Andrew. My best friend lived through that, and we bought property. So I've been an investor in Florida for a long time. So I have had money here for 30 years doing, new builds or fix and flips and that type of thing. So I'm not a stranger to Florida completely, but never thought about moving here. What started to get my attention was the rules in California as far as favoring tenants over ownership, tenant rights over ownership rights. And also, remember we voted against rent control on a ballot, and then next year we had it. And so I just thought, well, why did we get to vote? And so we had a legislative panel at a seminar. So these are the people that make the rules were on the panel. That was very interesting to hear what they had to say. And there was a progression of rights taken away from people to people that are in charge of decisions, depending. And so the pandemic was the ultimate. So you had a governor that could proclamate things into existence. And there was very little pushback. And so I just started thinking that I'm very uncomfortable with that. We had an eviction about 3 years ago in California that cost $50,000. And you're just going, wow, the guy knew every trick in the book and had no business being there, but that's what California did for him. So I just thought, you know what, I'm tired of that. And Florida has a very different way of looking at people that are in properties that are not supposed to be there. Much in your favor as an owner.
So why Florida? How if someone says, well, maybe I don't want to go as far as Florida because I would hope that maybe I could buy something Arizona, New Mexico, Texas, it'd be a closer flight, closer drive, what have you. What parameters are we looking at?
Well, management's the key from a distance. It's a key from any distance for that matter, but from 3,000 miles, you build a team before you buy a thing. So that's what I did. When I was in Colorado in the early 80s, when Grand Junction bit the dust, I knocked down every door and made a team before I bought anything. So I have to trust from a distance, and that was in place. But Florida, to me, it's got the biggest migration of people, not only from other states now, but from immigration as well. It's number one in both categories, and it's number one in a very significant category, migration of wealth. More wealth flows into Florida than the next 8 states on the list. So it is the favorite place for money to land. It has seniors that have medical needs, and as they grow older, those increase. And I mentioned to you, I read a report at 65, we have 2 people in our medical team. At 80, we have 7. That's a 350% increase. And so I just like those numbers. And oddly enough, in the ones that I built to own first in Florida, it was in a place called Leesburg. I was next to a place called The Villages, which is known for a senior development. They're one of the largest developments every year, building tons and tons of houses. I thought my renter was going to be a senior that didn't want to live in that environment, but my renter is predominantly a nurse or a doctor. And they live in my rental for a couple of years and decide to stay and buy a house. That's how I lose a renter. Getting replaced.
It boils down to the economics and ensuring you have the right team in place. What you're saying is don't just run and buy something because the cap rate's high and it looks price per unit is cheap.
No, no, you have to have a team you trust because, okay, I've lived in Florida now for 2 years. You know how many times I've seen my rentals since I've been here? None.
Wow. That's the way to do it.
Yeah, I don't need to go see them because of course you have ways that you can have pictures of it anytime you want to, but that's exactly what I did in California, by the way. I own rentals after we sold everything and we bought back stuff in 2009. From the day I bought it to the day I sold it, I physically never saw the property again. That's the truth.
You sound like my wife. We have these buildings, different places, and I didn't even know that she's been to all of them. But now, so to that point, I self-manage my properties. I rarely have to go because when we purchase them, more times than not, we put them through substantial renovations,
Yep.
capital improvements, rehab, if you will. And that's very key in California because with statewide rent control, that's one of the few ways that you can still give a notice to a tenant to vacate, 60-day notice, have them vacate. And you have to do substantial improvement, electrical, plumbing, something like this. But then if you overhaul the unit right, you bring it to market level, above market level, if you follow the apartment dealer plan. And the reason why I'm going through that, and for those of you that are hearing this for the first time and you own multifamily property here in California, and you're saying, really, you can give tenants a notice to vacate? Yes. Go to our YouTube channel. I've laid out in interviews with real estate attorneys, we've laid out how this all works. But the question for you, Bruce, is aside of being an investor, educator, you're also a hard money lender. I recently purchased a multifamily property. Your firm is the one who lent us the money for this project, and we're renovating everything. And you'll be happy to know that we gave all the tenants a notice to vacate under substantial improvement. The last one will be out at the end of this month, and we didn't end up in eviction court with any of them.
Wow.
So I'm
good.
safe, and your investors are safe because everything is working out well. But let's say many of these investors, their rents are low because they've owned the property forever and they want it to be nice to the tenants and keep things affordable. But now because of rent control, interestingly enough, their hand is forced to raise the rents.
Right.
Do you have a loan that you think would fit for someone that they say, look, I want to take out 200 grand and I'm going to go through and renovate this place. And I'm only looking for 2-year, 3-year money, but I don't want to go refinance my property because I don't want that much equity and I don't want to prepay for 5 years. Is there a loan product in the Bruce Norris world that would fit for a landlord like that if it was backed by a property that say is essentially free and clear?
Well, if it's, what we don't do is we don't do seconds. So it would have to not be essentially free and clear. It'd have to be free and clear. Okay. We just don't do seconds. So if it was free and clear property and you wanted to do something like that, obviously that's a very safe loan. We would be very interested, but we just don't do seconds.
Okay. So for those of you watching who may, after going through our YouTube video, say, you know what, a substantial improvement project looks good for me, but I don't necessarily have the funds. We use Norris and his firm for the hard money, private money, because they're not shark loans. And and I'm not just saying that because Bruce is here with us today. You can imagine how many solicitations I get as a commercial real estate broker on hard money. And Bruce is the only one that I deal with because I look at a lot of these other people, they almost want to set you up to lose because they hope to get the property. Bruce sets it up so that you win. He doesn't want your property, that you win and he win, and his investors on the back end are happy. And so it's just a really good formula. And so I highly encourage you to take a look at that.
Thank you. Appreciate that.
Yeah. No, of course. Well, we're about an hour here. For those of you that may have a question for Bruce, you can either go there, I believe, to the Q&A or the chat that's at the bottom of your Zoom screen there, and we could take a couple before we exit here. One
Chris,
person already.
While we wait, can I just plug our charity event next Friday?
I'm totally against charity, Joy. Never. Of course. Please do.
So next Friday at the Nixon Library in Yorba Linda, we're going to be hosting our 15th I Survived Real Estate. So we're going to have another great panel. It's going to have the Deputy Chief Economist of Fannie Mae, John Burns of John Burns Real Estate Consulting, Sean O'Toole of Property Radar. We're going to have our builder from Florida on the panel this year. It goes to benefit Make-A-Wish of Orange County and the Inland Empire, and St. Jude's Children's Research Hospital. We pay for the whole event. So every dime that we raise goes 100% to the charities. It is a $200 a seat event. We do have some individual seats, and if you want to put together 10 people and get a table together, we'd be happy to accommodate there also.
Thank you.
Okay. Yeah, they're giving me a note here that if you want to submit a question, it's in the Q&A, not the chat. I said that incorrectly. Now, I have a question here regarding the Florida investments, Bruce. So the way I understand it is if I want to purchase one of these homes that's being built by the Norris Group in Florida, you essentially kind of set up the whole package. You can set up the financing, you set up the tours, you also do a boot camp so people can see what it's all about. You interview them, make sure they're a good fit, because not everybody should own long distance. Anything else in there that I didn't mention about how this process works to invest in Florida?
Well, basically, it just started with me doing it. And then I had investors come and say, look at my portfolio. And I found out a lot of people didn't love what they had, but they just had lots of equity and it did cash flow. So that's kind of what started it. So we found a trustworthy builder. He'll be at the event, and I think he's probably got under construction somewhere between 70 and 90 homes right now. Each of those are being built directly with the owner. So the Norris Group is a broker in that sense. What we set up all the costs as far as the opening bids, as far as there's an equity position left for the client. I'm trying to think of what else. Yeah, we require a boot camp because a lot of people who are experienced in California can come to Florida and make some horrendous mistakes. And so we have people sometimes that are one gentleman's worth over $100 million and didn't want to spend a grand to go. And I just said, it's okay for you not to buy anything from me, but I don't, because I said every time, he'll call me, and he called a few other people in our company. Every question that you ask is in the one day material. So you need to know that, and you need to know it. But anyway, so that is a process. We have everybody go to the boot camp so you can meet the team. That's important. Go see the product, understand that Florida construction is different. We just had a 150-mile-an-hour hurricane go through the city, Cape Coral, where I happen to have construction projects. And so Craig, the builder's got 80 of those. We suffered, he's texting me in middle of the hurricane. Wind is consistently 150 up to 190. Okay, so that's a serious hurricane. And by and large, we have some roof shingles off. So that Florida's had to raise the standards of building.
Sorry.
Yeah. So Florida has to build things in mind. And that's why you don't go. So somebody comes here and says, oh, I get to get a much better price on a used house. Okay. You do that, but it's 7 feet lower in elevation. And if you just went through this hurricane, maybe it's now floating in the ocean somewhere and it's not insurable. So that's why you go through the education to say, this is why we land on this product, because it makes the most sense.
Somebody's asking, they had just refinanced multiple apartment buildings. So they're sitting at 3 to 4% currently. And these loans are fixed anywhere 5 to 7 years. Given that they fixed the low interest rate, should they hold or should they consider a 1031 exchange? My thought on that, Bruce, would be it depends on which way they think the politics are going to lean the next 5 to 7 years. If they're okay with the overreach of government and things only getting tighter and rent control going from 5% plus a change in CPI to 4% to 3%, because I'm sure it's going to change over time. If they're okay with that, then maybe you hang on. If you're the type of investor that wants more freedom in those sense, then I don't think California is going to be the place for you, because I only see things getting tighter. And anything you would say to consider, Bruce, as they're contemplating that 1031 exchange potentially to another state?
What's interesting about what you said about the apartment world finance and the 30-year financing that's available for single family rentals comes up with a different answer for me. So if I have 30-year financing fixed at 3%, 4% for a rental, and it's a residence, a rental single family, I'm locked and loaded for the duration of it. That's a very short time frame to trust that that's not going to be something that's double that. And so that's where your cap rates come in. So I'd love to see a long journey of a cap rate. I bet that it's been almost never at the level it's been in the last 4 years. And
oh, sure. Yeah. Cap rates have been historically low. That for sure. Yeah. There's no question about that.
Okay. But see, that's because the mood of that product. So think about why that even started to be the product. In 2009, you had 1.5 million people get foreclosed on, who no longer could buy a house for 8 years.
And become renters.
They became a renter. That was the force of that event. So, I mean, you've gone through the best cycle. So it's really interesting. Now there's other choices. So a cap rate that's less than a T-bill, let's say, wouldn't be too exciting.
Right.
So I
for
so
the
I
risk
think
and everything involved. Sure.
Yeah. So it's just it'll be interesting to see how it plays out. But your guys don't have any vacancies, right?
No, we personally don't have any. It just depends, I guess, what locale, quality of the property, but vacancy has been very low. Of course,
Right.
It's been very low.
Right.
Somebody's asking here, with respect to the Florida projects, if you cooperate with 1031 exchanges. So let's say they're in escrow to sell something right now. Can they purchase something and they're not going to close, say, for another 2-3 months? How that would work on your side of things?
Yeah, and it's a difficult thing that's gotten more difficult just because of material shortages and certainly a hurricane. So I would honestly say doing a 1031 exchange, you're going to say, okay, it's up for sale. There's no way to match that because you're going to try and buy an existing property, right? The Florida market is still crazy in demand. As a matter of fact, hurricanes exacerbate that. So you literally had 10% of the inventory of Lee County destroyed. So 10% of the owners are going to get a very large check and still live in Lee County, most of them. Okay, so that puts unbelievable demand on housing, both for rent and for ownership. So a 1031 exchange, when we have our event, all of that has to be done up front. You get the lot, we get all the way to the permit stage. I mean, we're literally ready to start your home when you close your sale escrow. And that journey takes some time. That's about a 5-month journey to go. We're going to find the land and we have a permit today.
So I think you need to reach out to Bruce Norris's office, and Joey can give us some contact information towards the end here to question more and get some more information. We'll take this question. So they want us to stick our neck out a little bit. So our predictions for single family and apartment values in 2023. So I'm not going to touch houses other than to say you got to consider what's going on in the economy and see what that tells you. For apartments, I think values will be down in 2023, and this is going to be recorded and posted. So I have to stick to that. And aside of the government doing some big push to bring interest rates down or something that would affect the economy in a big way, another big push of money into the market, I think that would be suicide.
Yeah,
economically speaking.
Yeah,
but the interesting thing is we have an election here in November. We're leading up to another election, and not to get political, but they're going to paint the pig as best as they can to make it look as best as they can. And so aside of some type of government intervention or a swing in rates, I think you would have to guess that values will be impacted next year. What do you think, Bruce?
Yeah, I think they're going to be impacted, but to know how much, all those factors I mentioned are going to play a role in stopping that damage, unless you get to the point where unemployment is a dominant, it creates the inventory that's motivated. So many people lose their jobs that cannot make their payment or cannot rent it for the payment they have, rent it out to somebody. See, that's what mitigates it. So it's just really interesting. I laid out all those scenarios to say this is yet to be played out.
Mhm.
If it's just a math formula, you go from 850 to 5. That's it. So all these other factors build back in a price. 50% of your buyers are going to be cash, but you are going to have an industry that does half as many transactions. Think about that. So if you're an agent, okay, it ain't gonna be 400,000 transactions, it'll be 200.
Yeah,
And
a lot will be pushed out for sure.
yeah, that's right. So it'll definitely be damaging to the industry. Refinances at 50% of the mortgage market typically. Well, forget that.
Yeah, no, things are changing, and real estate's a big portion of the GDP. One other reason that I would say that if we don't have the sales and mortgages and so forth occurring, then that hurts the overall economics again. Well, Bruce, thank you again for being with us. I'm seeing a note here from Joey that if you have questions about what it is that Bruce and his team do in Florida, how to invest and so forth, you would email Joey, Joey, at thenorrisgroup.com, Joey at thenorrisgroup.com. We will take this video. We're going to post it over on YouTube. So be sure to subscribe to our channel if you haven't subscribed already. Our next live interview will be with none other than Mr. Mike Brennan, eviction attorney. And we will be going through as they pull back on the LA County eviction moratorium, as these new RSOs are being announced in these individual cities. What does that all mean? What is projected for next year when it comes to legalities of owning multifamily properties, especially when it comes to landlord-tenant relations? And of course, taking your questions. So you want to be on the lookout for that. Mr. Norris, once again, we thank you for your time. Thank you for your contribution to the industry.
Mr. Norris, man,
I'm sorry, force of habit. My parents taught me well. So.
Yeah, they have, but no, you and I are friends. So Chris, thank you very much for having me as always. And by the way, you are the reason I go and fly into California and do those events. This time I couldn't, but you're the reason. I have a lot of respect for who you are and how you do business. So that's why I'm here.
Thank you, sir. I thank you. Thank you. And to all of you, we will see you soon. Take care.